You've probably heard of living trusts, and if you're a real estate investor or business person, you probably know about LLCs. But do you know the advantages of having your living trust own your LLC? Well, you will after watching this video. Welcome back to our channel where we share valuable insights into real estate and RE investing.
Welcome to Rock Real Estate with Simone, where we make real estate informative and fun. And now, here's your associate broker, real estate attorney, and mortgage loan originator, Simone.
Today, we'll be delving into the benefits of using both a limited liability company, LLC, and a trust when holding real estate in California. Owning investment properties can be highly rewarding, but it also comes with significant risks. So we'll be talking about how an investor can mitigate these risks with the LLC plus trust ownership strategy. Now, before we dive into the advantages of using an LLC and a trust, let's recap the risks associated with owning real estate. Now, if you listened to me before, you know I strongly believe that real estate is the bomb when it comes to growing your wealth and providing for your family for generations to come. But there is liability exposure from unforeseen incidents, such as slip and fall accidents, environmental issues, and crimes occurring on your property. Any of these can lead to lawsuits and possibly adverse legal judgments against you, or I should say the owner of the property. As you can see, asset protection should be a critical aspect of every real estate investor's strategy. Obviously, it's important to have a good insurance policy in place, and it's important to read these policies very closely, especially the limitations and exclusions to coverage. But to safeguard ourselves fully, we also need to explore alternative ways of holding the property by title. By incorporating an LLC and a trust into your holding structure, you can create a robust defensive shield against lawsuits and other financial liabilities. If you own a rental property or properties, and this can include renting out rooms in your own home or having an ADU that you rent out, you definitely do not want to have ownership or title in your own name, as you would be personally liable to pay off a judgment. Fortunately, there are several ways to hold investment properties other than in your own name. These include corporations, limited partnerships, LLCs, and trusts. While each option has its merits, today we'll focus on LLCs and trusts, as these two are considered the preferred entities for real estate investors, and even better when used together. Now, LLCs offer a myriad of advantages for real estate investors. For one thing, LLCs avoid the double taxation of corporations, or C Corps. Just so you know, currently the double taxation for a C Corp is 27% for federal plus 9% for California. Plus, you are taxed on whatever you pay yourself for personal use. Most importantly, LLCs and corporations offer asset protection for all members. In other words, if the LLC is sued, the individual member's personal assets are typically protected from liability. Yeah, that's great, huh? The number one rule in asset protection is to separate the property from your social security number. Now, business entities, which have their own tax ID, do this, while sole proprietorships do not. If somebody sued your LLC, the only way for them to get money out of you would be file a charging order and then proving that there was negligence, illegal activity, malpractice, or something like that on your part. That's called piercing the corporate veil, and it rarely succeeds. Additionally, forming an LLC is relatively inexpensive and nowadays a straightforward task, with online companies such as LegalZoom making it an attractive option for investors. Having a single LLC for all your investment properties is convenient and, as you might expect, costs the least. Now remember, if you are a resident of California, meaning you live here more than half the time and your bank accounts are here and the money's going into them here in California, then any legal entity anywhere will cost you $800, even if you don't use it. If you've hung around real estate investors, I bet you've heard talk of Nevada or Wyoming or Delaware or Texas LLCs, which do have certain advantages, such as more privacy and protection for members and officers than California LLCs. But did you know that the California Franchise Tax Board will charge you $800 per year even if you formed your business entity in another state, which would be called a foreign corporation, by the way. So when thinking of that cost, you might not want to follow the advice of top real estate gurus based in other states who advise investors to have one LLC for every property. So if you own 4 properties, at $3,200 per year is just for the LLC California registration. But on the other hand, you might decide that this expense is worth it. So why would we want to have multiple LLCs, preferably one for each property? Well, the short answer is you isolate your liabilities. All right, what does that mean? Well, let's say you own 4 rental properties in one LLC and a tenant's kid falls into a hole and gets seriously hurt. If they prove you were negligent, they could be paid damages from that single LLC, which means you might have to sell several of your properties to pay off the judgment. If the judgment is massive, you could lose all 4 properties and pay a huge amount to the plaintiff. But if the LLC that was sued had only that one property in it, the plaintiff would only be able to collect 1/4 as much. So the other 3 properties would be safe. So you can see that the multiple LLC strategy reduces your liability exposure. Another positive is many banks and lenders view this strategy favorably when considering loans and security interests. Oh, and an important note. While you're paying the $800 per LLC if you reside in California, this expense can be at least partially tax deductible. Yay! So in the end, you can see why it's important to have a good CPA on your team, because they could help you get the gain of asset protection without the pain of high taxes. Okay, let's talk about trusts now. As you may know, I draft estate plans with my law firm, Simone Legal PC, and I love trusts, particularly revocable living trusts. And they are an essential tool for estate planning and efficient asset distribution after your passing. If you own real estate and care even the least bit about your heirs, you simply must have a living trust. Otherwise, your loved ones would be forced to file a probate case, which means having to hire an attorney who's not cheap and spending 12 to 24 months in court, and the judge, not you, would decide who gets what. So if you're interested in trusts, watch my video which shows no less than 9 benefits of having a living trust. In that video, we dive deeper into the world of revocable and irrevocable trusts and estate planning. From avoiding probate to minimizing estate taxes, the right trust can make a significant impact on you and your family's financial future. Now, honestly, a trust alone does not provide much in the way of liability protection, but it does become an integral part of a powerful asset protection strategy when paired with an LLC. Simply by designating your trust as the sole member of a one-member LLC, you add an extra layer of protection for your property. Anybody looking to sue you and get money out of you would now have to not only pierce the corporate veil of the LLC, but then if they've done that, they still have to deal with a trust. And it might be harder, if not impossible, to locate the LLC in the first place because your name would not be associated with it. It would be trust. For those who own a business and wish to integrate it into their estate planning, it's essential to know how to transfer your business interests. Forming an LLC requires careful consideration and adherence to specific legal requirements. The process varies depending on the business type. For limited partnerships and LLCs where business interests are only partly yours, you can transfer your portion to a trust with an assignment of interest document. Similar steps apply to general partnerships, where an assignment of business interest document can facilitate the transfer. With corporations, a straightforward assignment of stock document is the ticket in most cases. However, for sole proprietorships, meaning the business is just in your name, cannot transfer business interests to a trust. However, you can transfer the assets that make up your business to the trust. Now let's discuss the tax implications of holding real estate in an LLC and a trust. While these structures offer significant benefits for asset protection and estate planning, for many of you, the tax implications will be a lot less than you might expect. Most LLCs, and especially single-member LLCs, are called pass-through entities because they are taxed directly to you, which does eliminate the double taxation of a C Corp. Now, S Corps do have several tax advantages, but if you are a buy and hold investor, you do not want or need an S Corp, as the benefits of the S Corp apply to ordinary income, and rental income is a different kind of income. In other words, S Corps are for rehabbers, flippers, those who buy and sell within a 1-year period. But fear not, buy and hold investors, you have a huge palette of tax deductions. Next level tax planning might be to accelerate enough depreciation to offset cash flow now and push the rest into the future with carry forwards. So to summarize, investing in real estate can be incredibly rewarding, but it's essential to protect yourself from potential risks. By utilizing both LLCs and trusts, you can secure your investments and achieve optimal financial well-being. By holding each investment property in a single member LLC with the Living Trust as the sole member of the LLC, we can achieve an added layer of protection from the LLC and benefit from the estate planning advantages of the trust. This combination allows investors with multiple properties to mitigate liability risks while also ensuring a smoother transfer of assets to beneficiaries in the event of their passing. Now remember, seeking professional advice is always wise when navigating legal and financial matters, and this is an area where having a tax professional who is well versed in real estate and real estate investing is an absolute must. Now, if you found this information valuable, please give this video a thumbs up and subscribe to our channel for more insightful content on real estate investing, financial planning, and estate management. As always, thank you for watching, and we'll see you in our next video.